the moderator, I go in the middle. I always love the word moderation because it sounds like you're sort of mediating between the Palestinians and the Israelis, but I'm sure this will be very collegial and there won't be any combat. I'm very lucky to be, it's quite low down here, isn't it?
It is quite low down. We could just stand up.
I'm a bit taller than both of you. So I'm very lucky to be moderating this panel because we've got two exceptional people on the panel on either side of me. One is a very dear friend of mine, Merryn, who I've known for a long time, and who, as Manos said, is the editor of MoneyWeek, which many of you will be subscribers to, and it's a must-read publication. And Merryn's also writing for the Financial Times and doing lots of other stuff besides. And so we're very lucky to have her here today in her capacity as an unpaid advisor to Netwealth and an early supporter of the whole concept that Charlotte Ransom, who is the co-founder and CEO of Netwealth, which is a very interesting company. And indeed, I'm trying to establish a back-channel communication with one of our businesses and Charlotte right at the moment. And I think you'll be very interested to hear from Charlotte about the history of her business, why Merryn got involved in it. And then Charlotte takes a market-neutral approach, as I understand it. It's not recommending directional trades for investors. But Merryn and I are very much in the market advice game. And so we'll probably be throwing a bit of that in as well. And so I'm going to kick off and ask Charlotte if she'd like to give a potted history of both yourself and also how you started this business and why you started the business.
Yes, thank you. Thanks, Jim, and thank you, Merryn, as well for joining today. It was very interesting for me to think back when I began Netwealth because I had spent 25 years as an investment banker, 5 of them at JP Morgan and then 10 at Goldman Sachs. And my last 5 years at Goldman Sachs, when I was a partner there, I was co-head of private wealth management. And it really wasn't until I'd spent some time in the private wealth side of the market that I started to think about what are the different types of offerings that are available, how different are they from one from the other. And actually, more distinctly, I started to recognize what some of the disadvantages were to the offerings that were available. It wasn't until I retired from Goldman, and actually somebody asked me, why on earth did you retire from Goldman? Who does that type of thing? And my response was, well, after 20 years, at what stage is it okay to consider you've done your time? So after 20 fantastic years, I left, and actually I was then trying to think about what to do with my own money, and simply couldn't find a wealth manager that fitted the criteria that I wanted. And I was acutely aware of things like the lack of transparency, the high costs, the fact that technology wasn't typically built into a traditional wealth manager the way a newer wealth manager can. And that's really what inspired me to start Netwealth. My co-founder, Tom Salter, had also been a banker, but was a different point in his career. He's 10 years younger than me. And so we quickly realized we could design something that actually covered really the full age spectrum in terms of its utility. And then, of course, we started to think about, well, who should be part of this? And we started really with, well, who's going to be in the top team? And what we felt strongly is that it should very clearly be staffed with people who had been excellent in their different areas of expertise in their previous roles, and then build from there. So Ian Barnes, who runs the portfolios, has got 15 years of experience running portfolios at Schroders and then UBS Asset Management. Our head of operations, Rachel Willocks, came from JP Morgan, multiple years heading operations. Matt Conradi, our client advisor, came from Merrill Lynch and Julius Baer background. We also were thinking about who would we want as our advisors. And there were 2 people who I went for first off. One of them is Merryn Somerset Webb. My father has been a fan of Merryn from the time I was in nappies. I don't suppose actually that could be true because Merryn wouldn't have even been born. But he's been a
combat.
He's been an avid follower of the markets for his whole life, and he is what many people, as I've met here today, are. Is very interested in investing for himself and also thinks about how discretionary wealth management fits into that. And Merryn, he is one of Merryn's biggest fans, but I've now realized Merryn has an enormous fan club and he needs to get to the back of the queue. But anyway, I was very, very keen to have Merryn be part of this because I share a lot of the, I think, some of the aspects of the financial markets and some of the problems with the financial markets we share. The other person is Edward Bonham Carter, who's also one of our advisors. And he is fantastically interesting. He's one of the best known names in asset management. And also, interestingly, his background is in active asset management. And we only invest in passive funds. We can invest in active, but right now only passive. And it was very interesting for me that he became such an interested person in net wealth. And he can very clearly vocalize why, he's grown up in active management. He totally believes in active management. It has a place, as does core passive investing. And so, we're very, very lucky with the people who've joined us from a shareholder as well as from an advisor perspective.
Well, thanks, Charlotte. It's a fascinating story, and it's definitely worth going to the netwealth.com website and having a look at the history and the people. And what I'm particularly impressed by is the rigorous concentration on the level of fees, because fees, we all know, eat up returns very quickly. And especially in a low return world, such as the one that we live in at the moment, fees are a major issue. Now, Merryn is the biggest champion. It's a neat segue into talking to Merryn of low fees from investment managers. And having been an investment manager myself, charging extremely high fees, and now retired on the proceeds, some of the proceeds, I want to ask Merryn, was that the thing that most attracted you to the net wealth proposition, the low fee aspect of it?
Initially, yes, obviously it isn't just about fees, but how many readers here? How many MoneyWeek readers? Yeah, so you'll all know what I'm obsessed with. Oh, not working?
Not working. No.
You all know what I'm obsessed with. I'm obsessed with fees. I'm obsessed with transparency. I'm obsessed with you understanding what you invest in. I'm obsessed with you being treated fairly by your providers. So it's fascinating to watch the journeys of people like Charlotte, Edward, Jim, moving over from the very expensive active world that they've worked in into a world where they become not the provider but the investor, and suddenly see what is important to the retail investor and then start working to provide it. So I first met Charlotte when I was looking around, very actively looking around for a group that I could partner with to help my MoneyWeek readers, because MoneyWeek readers come to me all the time, and I made a terrible mistake when I first launched MoneyWeek 18 years ago now, in thinking that what you all had to do was DIY everything, that everyone had to take full responsibility. You all had to spend hours every week, every month, stock picking, looking at different funds, doing all the metrics for yourself, etc. And it took me a good decade to realize that an awful lot of our readers don't want to do that. What they want to do is read the magazine for entertainment's sake, put 10-20% of their money into active management, manage it themselves, etc., and the rest they want someone to take care of for them. But there was so much of the industry that I didn't approve of, and until, even 10 years ago, no one ever talked about fees. Even fees weren't considered to be a major part of what you thought about when you invested. So looking for a group that I could partner with MoneyWeek, to send my readers to was an impossible task, and it never really happened. But along the way, I met Charlotte and found out about net wealth and what she was doing there, which was pretty much exactly what I had thought would work for so many of our readers. A low-cost, transparent, passive business that could take the majority of people's funds and put them to one side. You don't have to worry about them, and then you can spend the rest of your time thinking about Jim's recommendations, which is a lot more fun. So that was how we met and how it started.
Oh, that's fantastic. So let me just ask you a question, Charlotte. If I've got £100,000 and I'm looking to put it into your platform, is platform the right word, really, or fund or proposition?
Service.
Yeah. How would you address me as a client? Would you look at my level of risk tolerance, or would you assess that risk tolerance and then tell me what my risk tolerance is? I mean, what's the process by which a client goes through your proposition, basically?
Well, it's a great question, because there's quite a lot of platforms now that do a sort of risk questionnaire. And we have decided not to go down that route. In fact, when you come into the website at NetWealth, you're asked what your investing goals are. And as you work through 4 steps, you then come to our projections section. And it is on the back of the things that you've input that you get a series of projections, but you can then start to iterate. So let's say, for example, you came in with your 100,000 and you were trying to work out how much that would be worth in 10 years' time. You would put the time frame in, you would put the amount in, you would say whether it was in a wrapper or not, ISAs or pensions, and then you would say you're putting in 100,000. And you would then do the projection analysis, and it might be, for example, that you wanted to see, well, if it weren't in my ISA and I was having to pay tax, I can do that journey again, and I can now look at the difference between having it in an ISA wrapper and getting that return, whatever those projected returns are, tax-free, versus actually now seeing, oops, I'm a high rate taxpayer. So in fact, whatever that return was is actually less. And this is one of the things that's so important when people look to understand what their savings are worth and what they could be worth. If you can't assess, for example, how much inflation may go up over time and what change that would make to your projected outcomes, or you can't assess how much tax you're paying and again the impact that will have, that of course has a huge impact on that analysis you've just done. So for many of our clients, they want to know, for example, how much they can draw down in retirement. Whether or not retirement may be 20, 30 years off, but they want to know how much they can draw down and how long it will last. So you need to be able to model for some of these things like tax, inflation, and so on, as well as understanding what your time frame is and how much you're putting in the first place. But what clients can then do is they can decide which risk level they would like to choose. So there are 7 risk levels, and during that iterative process, they might put in risk level 4 because that's the middle one, which happens to be a balanced 50-50. But then they may say, well, let's just go up the risk level a bit and have a look at risk level 6. How do things change, both upside and downside? And so it's a very intuitive journey. What you haven't done during that time is talk about, this is my risk appetite, this is how experienced I am, and so on, and we make that decision for you. We would prefer to do that in person, so that if people actually want advice and they want to come in and talk about how much risk they'd like and what their investments currently look like and want a more full-blown discussion, then they can come in and have advice should they choose to.
Fantastic. And on my £100,000, how much will you charge me a year to manage it?
So we have 3 different levels of fees. Our minimum is 50,000, and between 50,000 and 250, we charge 0.65%. That drops to 0.5% between 250,000 and 500, and then above 500, it drops again to 0.35. But one thing, if I can, that I'd like to mention, so let's say you had 100,000, and because Merryn's a really good friend of yours, you invited her into your NetWealth network. Merryn has got more than you. She's got 200,000. Sorry about that.
More combat.
So Jim at 100,000 would be charged 0.65. Merryn at 200,000 would also be charged 0.65. But when they join the network together, they're at 300, and you both drop to 0.5. Then you invite me in. I've got 200 as well. So between us now, we're at 500,000. We're all independent of each other, but we all dropped the bottom fee of 0.35. And then the cool thing is that the minimum, which was 50, actually drops to 5,000. So let's say we all had some children or some godchildren or grandchildren, depending on the ages that we all are. You can start to introduce other family members into your network, and they all come in at that bottom fee. So it's a way to create economies of scale across families or indeed friends.
But does that group have to, can it be individually in different risk segments, or does it have to be in one risk segment together?
They're completely independent of each other, yeah.
So basically, we should all form a club and then go for the lowest form of fees.
So the networks, we're allowed, each client can invite 7 people into their network. So, for example, my husband decided to set up his own network so that between us we have 14 rather than capped at 7.
Fantastic. Now, the UK is, it's got its problems, but one of the great things about the United Kingdom is that we do have enormous tax incentives for investment, which are often not exploited properly by individual investors. Now, Merryn is an expert on that. Would you sort of run through some of the key things you think people should do in order to take advantage of the tax incentives that the government is offering?
Turn my phone off first.
Oh,
Sorry.
it's on your watch, your phone. Yeah, amazing. Is that your broker reporting some trades? Right.
Anyway, it doesn't work very well, this thing. You can't really answer your phone with your wrist. It doesn't work that way. It is absolutely true. We have amazing tax incentives in the UK for savings. The ISA regime is absolutely brilliant. If you, between the two of you, if you're a couple, you can put, £40,000 a year now into an ISA. Do that over 10, 20 years. It's going to build up very fast. The pension system is fantastic now. It's become very simple, very straightforward. It's got these nasty limits limits on it, a taper limit if you're earning over 150, and a lifetime limit if you are up to £1 million. But put those two things aside, if you're young and you're saving, you can put pretty much as you can afford to into one kind of tax-free vehicle or another. And so I do think we have a really, really excellent system in place. There's no excuse for not saving tax-free in the UK. Is something more complicated than that you wanted? It's
No,
that simple. It really is.
That's...
And but what is important though? What is important is that people understand, which they often don't, what it means when they buy what people call an ISA or a pension. I often talk to people and I talk to them about their investments and I say, do you have an ISA? And they will say, yes, I have an ISA. And I will say, what's in your ISA? And they will say, well, I have a Barclays ISA or a Santander ISA or this ISA or that ISA. And they don't understand, I'm going off on a complete tangent here, but it's important. What they don't understand is that they have individual shares, individual funds, and hence individual shares held inside this ISA, so they have a connection to the corporate world. And what we have at the moment is a huge disconnect. I think it's a big part of the social tension that we have in the UK at the moment, that people don't have the understanding that they have their own personal connection to the corporate world through their ISAs, through their pensions, through, in particular these days, through their auto-enrolment. So when you hear the young or whoever railing against the greed and appallingness of corporate Britain, what they're not getting is that their own savings that are being taken in auto-enrolment every month are going directly into that corporate Britain that they think is doing them down. It's a very interesting dynamic in the UK at the moment. I'll write about this.
Good. So you've got a famous economist, it's Gerard Lyons, on your part of your team, basically.
Yes,
and then
right.
you two co-founders are also very experienced market hands. How often do you sit down and change your model to adjust the portfolios to clients' requirements or to your own views, basically?
Yeah, so Ian Barnes is our head of portfolio management, who, as I mentioned earlier, is ex-Schroders and ex-UBS, and Gerard Lyons is a very well-known economist, and he's our chief economic strategist. So Ian and Jerry and their team get together every day and talk about markets and what's going on. We formally come together once a month as an investment committee. And then quarterly, Edward Bonham-Carter comes in and joins as an external advisor to help us think through the decisions we're making. We have a strategic allocation, which is typically 90% of our portfolio. And our intentions would be if Jerry and Ian were, handcuffed and gagged and chucked in a cupboard for 5 years, that strategic allocation should be one that they would be pretty comfortable sitting with for some time. That's not to say we hope that happens, and it's not to say we don't change the strategic allocation, but that's the idea. We then have a cyclical allocation, which is more likely to be 10 to 15% of the returns over time. And that's where we're trying typically to reduce risk. It's not there to add alpha. It's really there to start trimming some of the places that we're concerned might add risk. So, for example, ahead of Brexit, we actually decided that the pound had more downside than upside. So we reduced some of our sterling exposure in a cyclical form. More recently, we've actually removed high yield exposure from the portfolios because we feel as though the credit spreads are no longer paying for the risk that you're taking with the high yield market. But these are small changes to the general asset allocation. But in answer to your question, we are looking at this every day. And I think one of the interesting things for DIY investors, perhaps particularly, as Merryn said, most of us want to spend our time on the things we feel passionate about and genuinely interested in. And those are the places we'll spend a lot of time in. So for your diversified portfolio of financial investments, actually to know you have a professional team looking at it and thinking about it every day on your behalf is a nice thing to know. And then, of course, there are formal committees when we make decisions as to whether we should make any changes.
And do you cover every major asset class with the passive funds that you invest in?
The answer to that is we could. We have the right to, but actually right now we're only investing in equities and fixed income. So we cover all of the global markets in equities, so US, Asia, Europe, UK and emerging markets, and then in fixed income, government bonds, corporate bonds and emerging market bonds. We could invest in commodities, we could invest in real estate, for example, we could invest in infrastructure, but actually if we take our core client base, almost all of us have exposure to real estate already. So actually by us adding it into the portfolios, it doesn't really help. And from a diversification standpoint, we don't view that it adds a lot of extra value.
And I understand that you're passported into Europe, so you can sell into Europe. Are most of your clients British, or are you gaining clients from overseas as well?
I would say most of our clients are British. I think I mentioned earlier in a talk, our classic client is probably between 40 and 60 years old, typically has money, looking to keep it invested, looking to grow it, not take too much risk with it. And I mentioned other characteristics which are quite common, which I actually used for myself originally starting Netwealth, which is time poor, probably cynical about wealth management services as they stand, and quite analytical, and prepared to spend a bit of time to make sure that they're putting their money with people that they trust.
And let's say I need to pay for some medical treatment, whatever it is, and I want my £100,000 rather back. How quickly can I get it back?
We only buy funds that are daily priced. So I would say worst case is 5 business days to get your money back. You mentioned $100,000. I know you meant pounds, but actually we run the 7 risk portfolios across 3 currencies. So we manage sterling, dollars, and euros. And that's why we also have international clients as well as British clients who, for whatever reason, want to have exposure in those other currencies.
And how many fund managers do you deal with altogether?
Well, we can work with any number of passive vehicles that we want. So we probably right now have about 45, but the universe is huge.
So just before I come back to Merryn, so as a £100,000 person, I go online, contacted you online, and then I have a physical meeting with one of your advisors in London, or do you travel around the UK to meet other people in other towns in the UK? How does that work?
Yeah, so you can do the whole thing online. So
Right.
for £100,000, people quite often just want to go online. If they choose to take advice, we can either do video meetings if you're not based in London or don't want to come to London, or we do face-to-face in our offices in Charlotte Street.
Fantastic. So Merryn, you're advising many people every week and very successfully. The proposition that Charlotte has, how much of someone's portfolio, if they're between 40 and 60, and let's say have £500,000, would you say should be devoted to that sort of proposition?
Well, do you know what? I've just been reading on the way here Taleb's new book, Skin in the Game.
Oh, yeah,
right?
yeah.
And I'm wearing my Black Swans shirt. I don't know if you see this in recognition of his brilliance. And so what I'm going to do here actually is not tell you what people should do. I'm going to explain my skin in the game and tell you how my portfolio is organized. So at the moment, I am divided, my own assets, investment assets are divided about, I think I'm about 25% with Charlotte, and about another 35% managed by myself through my Hargreaves Lansdowne account, and the rest is managed by, and shock horror, deep breath everyone, an old-fashioned wealth manager, my husband. So I think it's more honest of me, Taleb style, to tell you exactly what I do. But of course, this is legacy stuff because I've only started putting money with Charlotte relatively recently, and my money has been self-managed for a very long time, and my husband is quite bossy. So if you were starting from scratch with a pile of assets, I think I probably would at this point put more than 50% of it into a low-cost passive allocation at the moment. And then, this is a matter of how entertaining you find managing your own money. We have a lot of readers who find it extremely unentertaining. It's great to talk about, but the admin of doing it is absolutely horrendous, in which case you want to be the majority in a low-cost passive strategy that you don't have to do anything with. On the other hand, we also have a lot of readers for whom, their main retirement hobby is managing money. And that's much more fun if you're managing enough of it to matter. It's much more fun if you put 98% of your money into a passive strategy and then devote all of your energy to managing a mere 2% of it back to skin in the game. It's not going to be that much fun. So this is a very, very personal decision based on how much you actually want to be involved with investing. And, what I have found over the last 20 years is that something that I think is absolutely fascinating isn't that fascinating to other people. And this is a lesson I've learned gradually over years' worth of sitting next to people at dinner parties and thinking that they want to talk about interest rates and finding out they really, really don't. They want to talk about their kids.
Or even essence, or their health.
Or
right,
their health, yeah, or their diet, or whatever it is.
Yeah. So you're investing in passive funds. At any point, do you raise cash and have cash on deposit, or are you always fully invested?
We try to keep as little in cash as possible. So typically we have about 2% in cash, which is really there just for the wash to be there if necessary. And the reason is that being in cash is very corrosive. We often have clients who come to us and have spent a long time with too much money sitting in cash. And the reason that we do that is because we think it's safe and it's sort of nice to know you've got X amount in the bank. We tend not to think about that net of inflation. And actually right now with rates as low as they are and inflation 2-3%, you don't want to sit in cash if you don't need to. We all need a certain amount in cash, but there is a point at which you definitely want to start thinking about it being invested.
And if I've got my 100,000, I want to direct debit, say, £5,000 a month to you. That's possible, is it, as well?
Yeah, so in fact, it raises a very interesting point. We have people who put money in on a direct debit basis. Sometimes, they come in with the full amount straight away. I think what that raises is actually money is a very personal thing. And while we believe in centralized investing, so I mentioned 7 risk levels across sterling, dollars and euros, 21 portfolios in total, they are centralized. But actually how each of you is thinking about those portfolios, which risk levels and what you're going to use them for is very different. So if the 3 of us were all in, say, risk level 5, it might be I've got my ISAs in there, Jim's got part of his pension, and Merryn is thinking about it for school fees. And so Merryn would actually want to have monthly cash flows that would help her pay, in this case, for school fees. You might not be thinking about taking any money out for retirement just yet, but when you retire, you might have a specific monthly cash flows that, again, would be specific to you. And for me, for my ISAs, I might say just let it run, not thinking of anything yet. So the notion of bespoke is something which I think is very badly understood. And I find it very frustrating when private wealth managers talk about creating a bespoke portfolio, because in fact what you want to have is the best thinking of the firm. And we should all want the best thinking of the firm. And then where it becomes bespoke is what are we using that best thinking of the firm for? And that's where it becomes quite customized, because in fact how you draw down, how much and when is something that will be different for all of us in the room.
Brilliant. Well, you have a company that's been founded by extremely successful people that has one of the UK's top money advisors on its advisory board. In fact, 2 of the top money advisors on its advisory board, charges very low fees, and has a very, very strong proposition. It's that kind of combination, as far as I can see, of a fintech with a personalized service, and I think it's an excellent proposition. What I'd like to do is to throw, this is the first time I've done this today, to throw the floor open for questions from people in the audience. And if you do want to ask a question, could you be quite loud and keep it short? Don't make a statement, just ask a question. So would you like to go first, sir?
How is Netwealth different compared to me just going in and buying a load of passive ETFs?
So the question was, what's different about Netwealth from the gentleman who asked the question from just going and buying the ETFs himself, which is a very reasonable question. So, and that is what a lot of DIY investors do. So the point you're trying to make is ETFs are low cost, and so why not just do it yourself? So the first point is if you buy the ETFs, you have to find somewhere to put them. So you have to buy the ETFs, which are low cost. You then have to pay a platform to put them on. Typically, a platform is going to cost between 0.35 and 0.4%. So let's say all in you are now around 0.5 to 0.7, depending on which ETFs you buy. You come out at about the same cost as us, but you don't have a professional team doing it for you. So it really comes down to what you enjoy doing. Because for lots of people, they absolutely want to just build their own portfolio and let it go. But for many people, a bit like Jim and Merryn have been discussing, there's a point at which you realise, oh gosh, I forgot to look at the markets yesterday, and now this has happened, and I'm not sure now whether I should be selling. And remember, if you do remember to sell and you get it right, then you have to remember when to buy. There are 2 decisions every time you get in and out of markets, and you might get one side right and the other side wrong. So it's a very personal choice as to whether you want to be as close to the markets as that.
That was a great question and a great answer, I think. Okay, who else would like to ask a question, not answer one? Yes, sir.
We've heard today that caution is a very important consideration. Warren Buffett is 30% in cash. Is he wrong?
Who are you asking? Me or Merryn?
All of
Merryn, why don't you go first?
Okay, well, actually, I'm about 20% in cash at the moment. So, no, I don't think he's wrong. I think there is an awful lot of risk in the market, in markets everywhere at the moment. I wrote a column about this a few weeks ago when I compared global stock markets at the moment to a penny fall machine in a seaside arcade. Everyone know those? Everyone know what a penny fall machine is? So the coins fall one by one, and you wait, and every coin you think is going to make the crash come, and it never does. And global stock markets are a bit like that. You know, you see inflation coming through, you see wage rises in the US, you look at all the Trump tax stuff, and you see wages going up, and you see the bonuses people are getting. 4 million Americans have just seen themselves getting a proper cash bonus from their companies for some reason or another. All this stuff has got to feed through into inflation. It's got to feed through into interest rates. You look at valuations, you say, well, we're at cyclically adjusted P's that we haven't seen since 1929. Every measure you look at, it's all a bit bonkers. You look at politics around the world, you think something's got to make this market crash. And it doesn't. So you know that one day the 2p or the 10p is going to enter the machine that is going to pull the market down. So all you can do is the more expensive a market gets, the more cash you begin to hold. And that's generally the way I see it. You can't tell when this market is going to go. It may go on for a lot longer. There are markets that are properly cheap. Jim and I are both very keen on Japan, aren't we? So, I'm happily putting more money into Japan at the moment, and I'm also very happy to put more money into the UK at the moment. The UK is becoming bizarrely cheap relative to some other markets, particularly domestically orientated companies. The domestically orientated companies in the UK are about 10-15% cheaper on average than exporters. This doesn't really make any sense. Our economy is doing very well indeed, and lots of the, not so much in London you don't see it, but go up to the Midlands, move around the northwest, see what's going on in Newcastle. This is an incredibly vibrant and exciting economy that does not deserve to be discounted to the rest of the world. So there are markets that are good value, reasonable, and it's worth putting more money in. But on the whole, that penny's going to go in the next 12 to 18 months.
I completely echo that, and those of you who were at my session earlier will have heard more or less the same thing, which is always a dangerous thing, isn't it, Merryn? But I would add that given this wage-driven inflation that we're seeing or about to see, that gold and silver remain a must-have in a portfolio one way or another, either through companies or through those ETFs or futures or direct holding. But that having been said, I just want to make a point. You can see the advert for my book there, and don't worry, all the proceeds go to charities. So I'm not trying to enrich myself at your expense, but that book is making the proposition that the average life expectancy on this planet will go from, let's say, 85 now to 110 to 120 within 30 years, based on current technology, not the future technologies like CRISPR or gene therapy or stem cells or organ transplantation from animals into humans. If we live that long, we have to start thinking about how we're going to sustain ourselves, because it won't be the government that pays our pensions. And a proposition like Charlotte's is absolutely brilliant in that respect, because on a monthly basis or an annual basis, you can make an allocation into an ISA or a SIP. And your point about your platform cost relative to Barclays or whatever was an extremely good one. You're paying a very, very small amount of additional money, as far as I can see, to get really good professional advice from people who've made enough money that it becomes a vocation for them, rather than a desire to make ever-increasing fortunes. And so I think that everyone should be upping their savings. Everyone should be thinking much more about their future disposition of their assets, buying MoneyWeek, subscribing to Master Investor, coming to these shows, because you work so hard to make your money, and yet most people spend so little time thinking about it.
That's right.
And the difference between eating out of a garbage can at the age of 95 and enjoying a luxury cruise while you're gardening and traveling around the world is the difference between saving carefully and not saving.
Can I just add to that? Because this longevity question is something that comes up quite a lot. So when people go into the site and they model their pensions, we can see the age that people put in, and we almost always underestimate how long we're going to live. Now, one of the points is for sure people are living longer and they will continue to live longer. And this is where fees become so important. So just to give you an example, so if you had a 45-year-old who had put £250,000 into their pension and they were saving £700 a month from their wages, and they were going to do that until they were 65. That pension pot would last them 24 years with, call it a traditional wealth manager, charging relatively high amounts. For a wealth manager that's at 1% per annum cheaper in fees, that pot goes from 24 years to 40 years. Now, that really matters. So, depending on what your expectations are, in this case, that obviously takes you to over 100. The great thing about pensions, by the way, as I'm sure you will know, is they fall outside of inheritance tax. So if you
That's not going to last. I cannot believe that's going to last. I mean,
it may not last.
A mistake.
Well,
I can't believe it's going to last.
It may not last. if it doesn't last, you're worse off than you were, but it's still a vehicle right now that you should be saving into. But more importantly is simply that you could either now spend more in your retirement than you thought you could, or it will last longer and you can live longer and have a happier life as a result. So it really, the effect of fees on things like long-term savings is dramatic to a degree.
That's one point I want to make that I've been thinking about recently, because I've just been talking about the penny fall and the correction coming, et cetera, et cetera. And I was running an exercise with myself this week to try and think about what could make that view wrong. What is wrong with the idea that there is a proper correction coming, say a 20% correction. And there's lots of answers to that. One is that as you all know, you can fiddle the numbers on valuations as much as you like, and so you can bring the cape down if you fiddle around with various things. You can bring it down to only just over 20 by changing bits and bobs in the calculation. There's all sorts of other things you can do to make the market seem not so expensive. But then I was thinking about fees, because I was thinking about you, Charlotte, and I was thinking, if on average, over everyone's investment careers of the last 100-odd years, everyone has paid, say, something in the region of 2% a year in total fees, and suddenly, as a result of this huge pressure that me and other people in our industry have been putting on fee structures to bring them down so that most people are paying, say, 50 basis points a year, where's the other 1.5% going? Yeah. Now, this is important, because what's happening is that it is rolling up in the market. And so that is a weight of cash staying in the market that wouldn't necessarily have been there before. And that's one extra little argument for a slightly more bullish outlook than you might have had otherwise. It's not coming out in the same way it was before. I've got a lot of calculations to do on this. I've just been thinking about it. But I think it's another interesting add-on to this idea of what happens when you move from a high-fee environment into a low-fee environment. There's absolutely no negative connotations here at all.
But I would point out that 70%, I'll get to you in 1 second, of the S&P performance in the last 5 years has come from 10 stocks. All right, there's a highly concentrated market, and it's technology that's done that. So, most shares have not performed well in the United States, and I'm sure the same is here in the United Kingdom, where actually the market has been pretty lackluster, only 7.5% growth in the last 12 months. So we are at a kind of dangerous inflection point, I think, as Merryn said earlier, and I think very eloquently. And that level of concentration in just a few shares is something to watch out for. Okay, can we have, this gentleman here had a question.
Yeah, in the era of funny money, so we've got a young lad typing zeros into a computer. Where will that end? Because as I understand it, is fiat currencies always collapse. So what is the end game?
Well, I'll quickly give an answer to that. The only asset that over time appreciates representing human endeavor is stocks and shares, because it represents companies, people's efforts, new ideas, new markets. Gold will probably hold its own in real terms. Property doesn't expand, and so it goes up and down. Bonds have a finite duration and a finite price at which they're redeemed, typically. So the only asset that over the very long term you should hold are shares. And that's what Charlotte's doing. And she's choosing them effectively on your behalf. And then Merryn's recommending, as we are, individual stocks for those who wish to add to a portfolio. So funny money is going to erode the value of everything, as you call it. They've printed so much money, as we know, since the financial crisis. Now they're trying to pull back the punch bowl in most cases, with the exception really of China. Even the Japanese are reining it back in a bit. And that will be reflected ultimately in inflation, which is, sometimes stocks do well in inflationary times, sometimes they don't.
Well, what's going to happen to the pension limit of $1 million?
Yeah, no, I mean, this is a...
Here,
Yeah.
at 30 and 40,
Yeah.
then $1 million's going to be peanuts.
Well, it is supposed to, the LTA is supposed to rise with inflation, and it has just gone up for the first time, so it's not $1 million anymore, it's just gone up by, I'm not quite sure to what, but there's a small rise,
amount,
it's just
yeah.
gone over $1 million, so it should go up. The idea is it goes up with CPI every year. So to the extent that if there's inflation, your limit will go up. But there's a bigger problem, which is that the LTA is a ridiculous number in itself, because it punishes successful investment, and it does all sorts of things it isn't meant to do. So it's a terrible limit, and at some point, we will have a government focused enough to be able to sit down and say, boy, we've made some mess-ups in the pension system. We've made it, for the majority of people, we've made it incredibly simple and straightforward. You put money in, you get your tax relief, you have a pot at the end, you can do what you like with that pot. But for high earners or for people who've transferred from defined benefit pensions, etc., we've made it incredibly complicated by introducing the taper and introducing the LTA. So my hope is that a rational government at some point over the next decade will take those two things away. And possibly do something like limit the annual allowance, or give us a lifetime allowance on the way in rather than on the way out, something like that. There is a more rational way to do it. And one day they will listen to me.
Do you have a comment on that, Charlotte?
Not other than the fact that it is definitely more complicated than it needs to be, and that a lot of people come to us to talk about how they should think through those complications and deal with the current mess we're in the hope that it may change, but working on the basis that these are the parameters we have right now.
I mean, obviously 50,000 for me a year would be fine, but Jim, it probably wouldn't pay for his meals.
I'm very frugal.
Anyway, we know Jim's only got £100,000.
Yeah.
Charlotte told us.
Yeah, I've got some dollars as well, though. Does anyone else have a question? I'm sure there's lots. The lady in the front, please.
So I wanted to ask about, what do you think about cryptocurrencies, and what is your opinion, how it can be, and what is the perspective?
That's Jim's.
Okay, yesterday I met this, those of you who weren't at the session this morning, I met this guy called Vitalik Buterin, who started Ethereum. And he's a multi-billionaire at the age of 23. And as I said earlier, that my first visceral reaction was one of intense jealousy. Because there he has probably another 100 years, and he's putting a lot of money into longevity, by the way, and he's got all that money. My niece, who's in the room, works for a cryptocurrency. My nephew developed a cryptocurrency called Nano, so I've got to be very careful about what I say. But I think that the proliferation of cryptocurrencies is a fad, and it's a passing fad, and I would not put any of my money, and we did liquidate a lot of money in the cryptocurrencies earlier late last year. I think that you're much better off going elsewhere. And so the answer is, I'm not a believer in it, but I do believe in the blockchain. What about you, Merryn? They're connected, of course, yeah.
I'd agree with Jim completely. I think you have to be very careful of the currencies themselves. And I think I'm actually quite wary of talking about cryptocurrencies, because every time I write about them, I get them a stunning amount of abuse. It upsets people nearly as much as Scottish independence, which I try not to write about now because of the abuse levels. So cryptocurrencies are hitting that kind of level, which is always a sign that there's a bubble going on, because anything that makes people really angry usually has something wrong with it. But, there is, when I write about it, what I say is I think people misunderstand where the value is. The value is not in the coins, in the currencies. The value is in the underlying systems. So attributing the value to the coin is to miss the entire point of the technology and the process. So I think that what has happened here is that there's something valid and exciting going on, but everyone's putting their money in the wrong place. So, like Jim, I wouldn't touch an actual currency with a barge pole.
Yeah, you might want to go down and look at In Silico Medicine's stand, because he's got a clever idea. That's Alex Zakharonov. He has a coin that you get in return for submitting your medical information, anonymized medical information. You've done it, have you? It's yours, is it?
No, it's not mine, but we're making also the digital health platform
Yeah.
to collect data, and that was one of my ideas, to sell the data of the people, that they get the...
medical services.
They get some crypto coin in return.
Yeah, and it's a good idea. And
then what can they
his
do
side
with the
is
coin?
to spend the coin on medical services.
Spend the coin on medical services.
There are people who are interested in this data. All data can be sold. Now
Yeah.
it's all in cloud, and nobody knows actually nobody can do anything with that because of regulations. But if the client who actually running or jogging or doing some sports, and I see this data and I can say, okay, woman 37 years old making sport free time, somebody can be interested in this physical data.
Yeah, definitely. Okay. Well, I think we're really here to talk about NetWealth and its platform, but that's very interesting.
We're agreeing with you.
And so let's take 2 more questions, because I know that time's getting on and we're off to the pub soon to extend my life even further. Red wine, very good for you, by the way.
You talked about making your investments market neutral. How are you hoping to do that?
Well, it's less market neutral. It's more that we're not trying to time the market, so that they are globally diversified portfolios that we run. And they're really market beta that we're producing rather than being market neutral. So in other words, across the 7 risk levels, our highest risk level 7, has at the moment 90% in equities, 10% in fixed income, and that 90% in equities is globally diversified across the main markets that we discussed earlier on. So it's more that it's a stable set of passive investments that deliver market returns.
Fantastic. Right, so another question. Sir?
Hi, Charlotte. Are you guys interested in staying independent? What's to stop UBS Wealth Management or even Google, someone buying you guys out and then jacking the fees up?
That's a great question, because we think a lot about how this market is evolving, and we have quite a lot of the incumbents, so whether they're the banks or the asset managers, who want to talk to us because they all realise that they have got to do something about dealing with technology and appealing to their customer base the way that is appropriate for 2018. And they are all going through this process of, should I buy or should I build? And I think one of the interesting things is that sometimes when you listen to these banks and asset managers, what's really in their minds is, how do I deliver a service that's just cheaper for me to run? They're not actually thinking about the customer. They're thinking about themselves, and they're thinking about their shareholders. The really great thing about being independent and about starting this thing, we began the journey 4 years ago, we launched just under 2 years ago to the market, is that the client has always been at the center of what we do. And so when people ask me as the CEO what my vision is that we become the discretionary wealth manager in the UK and we remain independent. So while we may have shareholders, currently all our shareholders are individuals, we may end up with some institutional shareholders, but they will always be minority stakes, and we're never going to be jamming other people's funds down to our clients.
Thank you.
Great question.
Did you say you were going to recommend 10 shares to buy?
I did in my morning session. And in 10 days' time, those who were not at the morning session will have the opportunity of seeing them on the Master Investor site. By then, most people will have lost all their money in the shares that I recommended. So maybe some bargain hunting opportunities. There was someone at the back. There's lots of people. Right, the person right at the back, because can you stand up, please, so we can actually see you? Could you ask your question? Oh, you're the winner of the £10,000. Yeah, straight into the platform. Yeah. They're very cold. No, the lady is asking if we have any views on Nordic countries, and because they've been doing well, etc., etc. And the answer is, apart from what we've read, and that Finland's the happiest country in the world, largely because they seem to drink a lot of vodka. The answer is no, I think. Ask Merryn. Yeah.
I'm afraid I really don't have much of a view on the Scandinavian countries. I think there are a couple of individual companies that I've been interested in there, but I'm afraid as a whole, it's really not an area that I watch, and now I feel guilty. Sorry.
Okay, I did say 2 questions, but I think we'll take 2 more. Lady at the front here, can you stand up so we can hear you better?
Can I ask you about your view on machine learning trading and funds that run by machine learning?
Charlotte, that's one for you, I think. Yeah.
Yeah, so, there's a lot of discussion around artificial intelligence and machine learning. And I think so our technology is all developed in-house. And we are starting to bring machine learning in, really so that we can start to recognize more, understand more quickly things that are going on within the client base and understand how we can then get information back out to those clients. So whether it's behavioral aspects or specific things related to risk appetite and so on. We are, however, always conscious of the fact that we believe humans should be managing the assets and the asset allocation, and that we will always have human advisors. So I really can't see a chatbot as being the right thing to be advising anyone on what they should do with their pension investments. So I think, you know, we're slightly getting ahead of ourselves. What we've tried to do with Netwealth is really take the things that are really good about private wealth management and then make it much better through being technology enhanced. What we're not trying to do is shift the whole thing into you interacting with a machine and then expecting that everything is solved, even if that does deliver a lower cost service. So I think the technology is continuing to evolve. It will become more and more important to the overall experience that a client has.
Great. So one more question. No, that's no supplementaries, I'm afraid, here. It's not Parliament. And someone's hand is poking up there. Could you stand up?
There are two things that worry me about future investing. One is the change of government, and the second that they will start taxing ISAs. If we get one, might we get the other?
Merryn, that's a good one for you.
Yeah. It's a very good question. And if there is anything that should scare an investor in the UK, it probably is a Corbyn government. Because you will get, and I say this with some certainty, you will get a new parade of wealth taxes in particular if there's a Corbyn government. And I suspect you will see, this loophole whereby you can leave your pension IHT free, for example. That's gone. You may well see taxes on ISAs over certain amounts. So, we have a lot of ISA millionaires now in the UK. If you're an ISA millionaire, you may find that a Corbyn government is not going to work for you very well. More particularly, I suspect we'll see property taxes. There's a lot of discussion about a wealth tax on property itself. And, we've been very, very lax on this in the UK for a long time. We haven't revalued our council properties council tax levels for such a long time. There's enormous scope for someone who feels like taxing wealth to start with property and then move on to the vehicles that we do slightly take for granted have tax-free status now. I think you'd be an insane politician, but then, of course, to fiddle with the ISA too much, to tax it too much, because the ISA has been one of the greatest successes of investment and tax planning, ever, anywhere. And the faith that the British population have in their ISAs is enormous. And I think you could make yourself very unpopular very quickly if you went after ISAs in any way, except for at the very, very top. But of course, the rich don't matter. If you go after the rich, that's okay. So in today's political environment.
Okay. I'm sure I saw John McDonald at the back here, but anyway. I'd just like to thank the audience for being terrifically engaged in this panel and asking some great questions, really great questions. I'd like to thank Charlotte for, organising this event, and I think it's been, for me, it's been very useful. And of course, Merryn, for coming all the way from Edinburgh, and she is an unpaid advisor to this company, which is terrific. And if she's backing it, you've got to know it's good. So I'd like to thank you all. Thank you very much for coming. And I guess I'm going to see you all next year, hopefully. Thank you.